Hello everyone, welcome back to my channel. This is Dr. Ramishri MG, Assistant Professor of Commerce, Government First Grade College, Kumta. We'll discuss BCom 5th semester's Accounting Theory, Unit 5 Accounting Standards, Part 9 Accounting Standards issued in India. In the previous part, we discussed Accounting Standards 17 to 24. In this part, we'll discuss Indian Accounting Standards from 25 to 32. Indian Accounting Standard 25 deals with interim financial reporting. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1, 2002. If an enterprise is required or elected to prepare and present an interim financial report, it will have to comply with this standard. The objective of this standard is to prescribe the minimum content of this report and also the principles for recognition and measurement in a complete or condensed statements for an interim period. Regular and such reliable reporting improves the ability of investors, creditors, etc. to know the capacity of an enterprise to generate earnings, cash flows, and financial conditions. Accounting Standard 26 deals with intangible assets. This accounting standard comes into effect in respect of expenditure incurred on intangible items during the accounting periods on or after April 1st, 2003 and is mandatory for certain enterprises mentioned in the note given at the end of Accounting Standard 29. Further, in respect of all other enterprises, this comes into effect in respect of such an expenditure incurred during the accounting periods on or after April 1st, 2004 and is also mandatory from that date. The objective of this standard is to prescribe the accounting treatment for intangible assets which are not dealt with specifically in any other accounting standard. This standard requires an enterprise to recognize an intangible asset if certain criteria are not met. This accounting standard should be applied by all enterprises in accounting for intangible assets except those that are covered by other accounting standards, mineral rights and expenses, and financial assets, etc. Accounting Standard 27 deals with financial reporting of interest in joint ventures. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 2002. In respect of separate financial statements of an enterprise, this standard is mandatory in nature from that date. In respect of consolidated financial statements of an enterprise, this standard is mandatory where the enterprise prepares and presents the consolidated financial statements of accounting periods commencing on or after April 1st, 2002. The main objective of this accounting standard is to set out the principles and procedures for accounting for interests in joint ventures and reporting of joint ventures assets, liabilities, income, and expenses in the financial statements of ventures and investors. Accounting Standard 28 deals with impairment of assets. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 2004 and is mandatory for the enterprises mentioned in the note given at the end of Accounting Standard 29. In respect of all other enterprises, this accounting standard comes into effect in respect of the accounting periods commencing on or after April 1st, 2005 and is mandatory in nature from that date. The objective of this statement is to prescribe the procedures so that an enterprise can apply to ensure that its assets are carried at more than its recoverable amount if the carrying amount exceeds the amount to be recovered by use or sale of the asset. If this is the case, the asset is described as impaired, and this standard requires the enterprise to recognize the impairment loss. It also specifies when enterprise has to reverse the said loss. Accounting Standard 29 deals with provisions, contingent liabilities, and contingent assets. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 2004 and is mandatory in nature from that date. The objective of this standard is to ensure that the appropriate recognition criteria and the measurement basis are properly applied to the provisions and contingent liabilities of the enterprise, and that the sufficient information is also disclosed in the notes to the financial statements so as to enable the users to understand their nature, timing, and the amount. Further, the objective of this statement is also to lay down the appropriate accounting for the contingent assets. The enterprise should disclose the following for each class of contingent liability at the end of the balance sheet: a brief description of contingent, an estimate of the uncertainties relating to any outflow, an indication of the uncertainties relating to any outflow, the possibility of any reimbursement. However, the contingent assets are not required to be disclosed in the financial statements. Accounting Standard 30 relates to financial instruments, recognition, and measurement. This accounting standard will come into effect in respect of accounting periods commencing on or after April 1st, 2009 and will be recommendatory in nature for a period of 2 years. As a consequence of issuance of this accounting standard, a limited revision to some of the existing accounting standards will have to be made accordingly. This accounting standard establishes principles of recognition, derecognition, and measurement of financial instruments. For the purpose of this accounting standard, the financial instruments are classified into financial assets or financial liabilities at fair value through profit or loss, held to maturity investments, loans, and receivable availables for sale of financial assets and other financial liability. This standard also establishes principles for hedge accounting. Accounting Standard 31 deals with financial instruments presentation. This accounting standard primarily establishes the principles for presenting financial instruments as liabilities or equity and related principles of interest, dividends, losses, and gains. It may be noted that the principles in this accounting standard complement the principles established in the above accounting standard 30. Accounting Standard 32 deals with financial instruments disclosures. The exposure draft of this proposed accounting standard is issued by the Accounting Standard Board of the Institute of Chartered Accountants of India for comments on any aspect of the draft. At the end, accounting standards issued by the Institute of Chartered Accountants of India, which largely are based substantially and converged with IFRS standards, apply. Financial statements must be prepared annually in accordance with the accounting standards prescribed under the Companies Act. India has committed to converge its accounting standards with IFRS. These standards are called the Indian Accounting Standards or the IND AS. These are the references. Being good is good for business towards sustainable business. Thank you for watching.